The biggest questions we get from potential co-signers, number one, how is it going to impact my credit score? If they haven't bought a house yet, is this going to stop me from buying a house? When will this stop, right? And so those are the three questions we have to have good answers for before a co-signer is willing to engage, right? The slower that you pay back a loan, you have two sort of compounding effects that make it more expensive. The first effect is just that you have more principal due for a longer amount of time. The second effect is the lender is often charging you a higher interest rate when you're choosing to pay it back more slowly.
Getting an MBA is expensive, and most applicants will begin by doing an ROI, but even when it makes sense long-term financially, you still have to find a way to pay for it, and schools don't take IOUs. So today we're going to talk about how to finance your MBA. I'm Brian Phoebe, co-founder of GuruFi.com, and as always, I'm with Maria Vicvilla, the founder at ApplicantLab.com, and today our guest is Nikhil Agarwal from Juno. How are you today, Nikhil?
Juno is doing great, so is Nikhil.
Is this like when Donald Trump called the Apple CEO? What do you call him?
Tim Apple.
Tim Apple.
Appreciate it very much, Tim Apple.
You're Nikhil Juno. Sorry to. Hopefully your parents don't mind. How are you today?
Life is good. Really no reasons to complain, and very excited to be on here with both of you, Brian, Maria. Excited to be here.
All right. So to start off with, can you tell us what is Juno? How would someone who is looking to finance their MBA use your service, and kind of what problem is it that you guys solve with your business?
Yeah, absolutely. Juno is a interesting concept. It's really collective bargaining for better student loans, and it's heavily focused in the MBA space, in the graduate student loan industry space. So what we do is we ask folks to join, folks as in people who've been admitted or plan to enroll in the upcoming fall, to join really what's a wait list, maybe a data hungry wait list, but at the end of the day, a wait list. And when you join that wait list, what you're doing is you're adding your voice to the number of people who are looking for an attractive student loan option. Then we take that, call it demand, and we go to lenders, pretty much all the lenders that are popular in the space, as well as lenders you've never heard of. And we go to them and we say, hey, can you offer something that's better than the federal options, for at least for the domestic students, better than any other private option, right? And this should be broadly for the whole group. That's kind of what we are trying to accomplish. And really for the last 7 years, we've been able to meet that goal, where a vast majority of the group has found that their best option has been the one that we've been able to negotiate. I'll clarify that some people think it means we are trying to like blend someone with a high credit score with someone with a low credit score. That's not really how it works. Each person still gets their own rates and things like that, but it is better than what they could find by themselves. And it's a free process. Really, we make it super convenient for members. So that's what we do. And the problem ultimately is, trying to get everyone going to grad school, going to MBA programs, a much more affordable student loan option.
So Nikhil, when people apply to Juno, I guess you approach lenders with different pools of candidates instead of everyone collectively in one big chunk. I'm guessing, at least. So if you do divide people out into different pools, how do the lenders actually assess those different pools? Like, what are they looking at when they are deciding what offer they're going to give your clients?
I think the answer is going to surprise you. So size obviously is the biggest thing here, right? Like the larger the group, the more number of lenders we can get excited to participate in the process, right? Literally, the earliest example, when Juno first started, we were literally a Facebook group, right? We had 70 members in the Facebook group. We reached out to the CEOs of various banks. One of the banks responded. They basically said, in more polite words, but they said, that's cute, come back when you have 500, right? And so the size of the group is like the dominant factor in getting lenders to engage. Now, it is fair that the product features that are required are different. So, for example, folks going for an MBA, they tend to be very confident in their outcomes immediately after graduation. They don't care much about deferment policies on their loans or public service loan forgiveness, which is really a federal feature. Um, they don't value those options that much, right? So it doesn't make sense to take an MBA student and group them in with perhaps like a medical student who really cares about managing their payments through residency, and their career and their income profile is very different. They're still both great loans to make, but the product has to look very different. So that's really how we think about grouping our audiences, is to make sure, to get as large a group as possible where a similar product is going to accomplish the job, right? The other thing I'll add is we are fluid about it. So for example, if a lender comes in and they're really offering, a product that fits for multiple groups, we have no problem kind of combining those groups, right, to make it that much more enticing for that lender to reduce rates or improve, certain terms and conditions on the loans. Eligibility criteria is the other big one, right? We have this reputation of delivering the lowest rates. What people don't understand is happening behind the scenes is we are also fighting really hard for eligibility criteria and expanding that. So yeah, that's.
A lot of our listeners, or the people who come to GMAT Club, are international students, but there's also a lot domestically. I have kind of some specific questions about that, but can you say something kind of big picture maybe about what's different for someone who's coming from overseas who's looking to finance an education here versus maybe what the options are for someone who's domestic? And are they sort of placed in the same tranches of loan pools, or you view them as kind of very separate entities?
Absolutely, yeah. I would say there is a distinction, but domestic students and international students with a cosigner are really in the same group. Since Juno's inception, the deal we've been able to negotiate, call it the best deal, really for the MBA group, the deal we've been able to negotiate has always included international students with US cosigners. The international students without US cosigners has been one of those efforts where, year after year, we make a renewed effort, but not once have we been truly successful in creating an option that's better than what's already available. So oftentimes for international students, we suggest starting with the financial aid office, figuring out if there's any deals that the financial aid office might have made with any lender. And those tend to be the most attractive if it happens. It doesn't happen at all schools, it happens at a few schools. But if that exists, that tends to be pretty attractive for international students. And then after that comes, hey, try to find a cosigner, right? It's been interesting because when we ask folks, folks in India, as an example, who might send a lot of students, admission consultants, for example, who are sending students to the US, when they also get involved in the financing piece. And they say, oh, only like 7-8% of our clients have a cosigner. What we found is if you ask the question, hey, can you find a cosigner? Can you ask an uncle or an aunt or someone else? Suddenly that grows to like 33%, right? So I would say there's a population of people who have access to a cosigner but hesitate to ask. And we encourage them like, hey, make the ask. The difference between interest rates could be 12, 13% versus 6%, right? So in fact, yesterday I was talking to an international student. They got a US cosigner. They were able to drop their rates to 4-point-some%, which is like unheard of for even domestic students. So that's the second push. And then finally, there are options available for international students without a cosigner, but they tend to be pretty expensive. And they're not a Juno deal. They're just, what's available in the market. We're happy to provide guidance. Yeah, I think we've been much more successful with the domestic students and those with the US cosigner.
So I'm fascinated to hear this, that you said that 33% or a significant portion of people, once they start thinking about it, they can in fact find a cosigner. When they go to that US cosigner, when they approach them, how do you guide them to make that pitch? Like what because it seems to me like it might be very risky, unless if it's a family member that I know very well. I'm sure I might co-sign some of my cousin's loans, but beyond that, I don't know that I would be very comfortable personally. So what have you found works? If somebody does know someone in the US who might be a co-signer, how do you advise them? Like, do you have like a standard pitch that you give, or is there a recommendation?
I even get on phone calls where the student and the potential co-signer, we all are getting into a room together and chatting about it, right?
Wow.
So the biggest questions we get from potential co-signers, number one, how is it going to impact my credit score? If they haven't bought a house yet, is this going to stop me from buying a house? Then when will this stop, right? Like whatever these impacts are, when do they go away? And so those are the three questions we have to have good answers for before a co-signer is willing to engage, right? So what we do is we share data on and tools that can help co-signers simulate what's going to happen to their credit score if this shows up on their credit profile. The second thing we do is we share a process that you can have with a mortgage banker to make sure that your DTI calculation doesn't take into account something that you've co-signed for. And finally, we share the refinancing options that international students have to allow them to get the co-signer off the loan. And in fact, we've done a ton of refinancing to help international students, whether they took the original loan through us or not, either to remove a co-signer, but also just to reduce interest rates. Our international member base refinancing with us today, and these are folks who took a job in the US, right? Just to clarify, the average I think is around like 5.5%. So it is exceptionally low compared to, what students are borrowing at while they are in school. And it releases the cosigner when that refinancing happens. So all of these things make the cosigners a little bit more confident in engaging. But ultimately, there still has to be enough of a trust in that relationship, right? Because the refinancing action, it's taken by the student, not the cosigner, right? It's in the student's control. And what if rates go up? What if that student doesn't qualify anymore because they didn't take care of their credit card properly while they were in school? So there are risks. It's not risk-free. So there has to be a serious trust relationship before someone will. But I think when they're on the edge, these discussions and these tools help them decide, is this a risk I want to take? And really reduces their, compared to the perceived risk, the real risk might be low. So this helps them get a better understanding of what the real risk is.
So you mentioned the medical school difference between like, kind of the process, right? So my wife is a doctor, and when she was going through that process, it's not quite this way, but like you just kind of show up and they throw money at you because there's not a ton of concern that a doctor won't be able to pay it off. There's weirdness with residency and stuff that doesn't apply to MBA applicants. But it does make me wonder, like there's different types of MBAs, right? If you go to Wharton, that's fundamentally different than if you go to Southwest Louisiana Culinary School Business Annex, right?
Right.
Is that taken into consideration at all? So that if like I am in at Wharton, which means in all likelihood, I will get a job that will allow me to do this versus a 5th tier school or whatever. Does that affect your ability to get a loan, the rate that you get, or is it just a business school from the lender's point of view?
So there are some interesting factors here, right? If I asked a lender, hey, would you want to give the same loan to those two students, right? I think they might say, yes, but we can't. And some of this, each lender is going to have their own view on what they're allowed to do and what they're not allowed to do from an underwriting perspective, right? And there are definitely some lenders who take the view that we are not allowed to differentiate. If it's the same degree, but a different university, there are some lenders who might take the view that we are not allowed to differentiate. So there is that factor that happens, and I think lenders often, I think, look at portfolio performance, right? If a few loans, get in there, so be it. But I think it's more important to think about this from the student's perspective, right? Because the student doesn't want to default, right? And historically, we can talk about like things changing 2025 to 2026 because it's a big change, right? But 2025 and prior, students who were not confident about repayment payment abilities, right, or like strong incomes post graduation or immediately post graduation, they had the federal options, and the federal options were a good fit because they had income-driven repayment plans. If you were going into public service, they had public service loan forgiveness. They had the extended repayment plan. So there were things you could do with the federal loan that would not impact your credit negatively and allow you to have those funding in school to get through school. And over time, you would figure out how to pay it back, right? Versus with the private loans, it's just a little bit more rigid, right? The payment plan you sign up for when you take the loan is kind of the payment plan you've committed to.
So you alluded a second ago to prior to 2025 and prior. So are there any big changes on the horizon in the industry?
Yes, absolutely. So fall 2026, the class that will start in fall 2026, they will no longer have the option to borrow from the federal Grad Plus program. They will only be able to borrow $20,500 from the federal unsubsidized program, and anything they need beyond the federal unsubsidized limit, $20,500, they will have to borrow through a private loan. The federal Grad Plus will no longer be an option for those students. So and it will phase out. The class that's already enrolled, they are fine. They'll get through it. But 2026, 2027, and onwards, whoever is enrolling in business school, and this really impacts the domestic students more than the international students because the international students didn't have that choice to begin with. But the domestic students will no longer have that choice. What's interesting to note is we were talking to some financial aid offices and asking them, how prevalent is the usage of this Grad Plus product? And we were both happy to learn and interested to learn. Juno has predominantly already replaced Grad Plus at many business schools. Some schools were telling us that less than 10 Grad Plus loans happened on their campus, which was very interesting for us to find out.
Are you getting a sense that the lenders are becoming stricter or more flexible with international students, particularly if they don't have a US-based credit score or cosigner?
Yeah, I think I'll share our efforts, right? In the space, we've really gone every year pushing lenders to say, hey, can you broaden your eligibility criteria, start including international students? I think those discussions have really taken a back seat ever since the big beautiful bill changes. This Grad Plus elimination has come to the forefront because now everyone's mind is focused on, and bandwidth is focused on, hey, how can the private market serve this population that's going to need private student loans, when historically they've utilized the Grad Plus product. And that's distracted from the conversation of, hey, how can we expand eligibility for international students? So I hate to be the bearer of bad news here, but I think in 2023 kind of timeframes, there was still more discussion in how to make that possible. The primary challenges were, where's the data? How do I quantify this risk? How do I think about flight risk? These kind of discussions were at least active, whereas now it feels like there's not even room to have the discussion. Forget about trying to solve the problems that get identified from those discussions.
So are you seeing then is there a perception amongst the lenders that there's an increasing risk in giving out some of these loans, particularly to international students? And if so, do you anticipate the interest rates on these loans rising regardless of what the Federal Reserve does, on sort of a macro level? Do you think that there is a perception of increased risk for international students? And if so, do you think those rates will go up, or it's too soon to tell?
I don't know if people are paying attention. And really, I'm speaking about US lenders, right? I think the lenders who are more focused on the international market. I'm not really presenting that view. I'm really presenting the view Juno develops from conversations with US-based lenders, right? And I think that there's just not the mind space to think about it. For example, we had a pilot program a couple of years ago with one lender where we were trying to get more attractive rates than some of the international focused competitors available to international students, and that program ended up wrapping up over the last few months, primarily because the approval rates on that was not very strong, right? And we were like, hey, this doesn't make a ton of sense to put a lot of applicants through this and then just deny them, right? In a world where there was more bandwidth, right, more time, you could imagine that go in a different direction where, hey, how do we solve this, right? Okay, the approval rates are too low. Can we do something to improve the approval rates, etc.? But I don't think there's really the bandwidth for those conversations right now with so much focus on the grad.
So if you'll just let me jump in then. So what right now, if someone is an international student, they don't have a US cosigner, what does the landscape look like right now for them? Like, are you guys are you not serving this population? And if you aren't, then like what's the process looking like for those folks, if you happen to know?
Absolutely. We serve the population in the sense of we're happy to connect with them, talk about their specific options, things like that. We are not able to serve the population in the sense we're not able to find them something that's better than what's sort of broadly already out there. The discussion with international students without a US cosigner is typically alongside, hey, let's check in with the financial aid office at your school. What options have they seen the previous class utilize? Oftentimes it's just listed on the website. Have they done anything special? Because sometimes schools will negotiate with lenders and create an option for international students. So that could be interesting, but that's really program by program, right? It's not something that's broadly available. And then there are, we think of them as two categories. One is home country lenders, right? So lenders in the country that the student is coming from that might be willing to give loans to the student to study abroad, as well as lenders who just have a more international focus. Their whole goal is, they will have perhaps lists of universities that they're excited to lend to, and they try to make loans to international students attending those universities. Overall, what we find is those loans tend to be more expensive, both in terms of fees, interest rates, even the terms of those loans tend to be a little bit stricter. So it's not a better product than the ones domestic students have access to, but it is at least a product that allows them to pursue the education, right? Once again, we help on the refinancing side. Once they are able to graduate, land a job in the US, oftentimes we are able to then help them refinance it into a much more attractive loan.
Got it. Okay.
Can I ask you a two-part question? One is very much kind of specific to your service. So if someone is using your service, what are the nature of the options that you bring back to them so that they see? And like connected to that more universally, how would you advise people to think about this distinction or the choice between fixed and variable rates and how they should go about evaluating those options?
Yeah, absolutely. So for the first part of the question, students will, let's say they've decided, hey, I want a loan, right? At that point of time, we have a soft rate check on our website, which, again, domestic students, international students with US cosigners, both of those populations can use it. They submit that rate check, and what we do on the back end is go through the deals that we've negotiated and just lay out all the options available to that student based on their profile. Broadly, we find that 99% Well, I just went through some numbers today morning. We find north of 80% approval rates for that population. We find 99% have a rate less than the federal grad plus rate. We find 82%, don't quote me on that, somewhere in that ballpark, get a rate less than the federal unsubsidized rate, which tends to be pretty hard to beat. Um, and these are very friendly loan terms in general, right? Um, 10 or more year loan terms, a fixed interest rate that doesn't change over time. There are variable options as well, but the numbers I'm quoting, we find about 99% of our population in this, domestics and internationals with cosigners err towards the fixed rates. Talking about 2025, this has fluctuated over the years. Yeah, is that helpful in terms of results from that process? They tend to be very, very attractive loans. We don't. The reason we get such a widespread adoption in the MBA community is because of that. In terms of when I think about fixed versus variable rates, the way we encourage people to think about it. So first, I'll share this. We built this like complex calculator based on, call it, academic rigor, right? And it was looking at forward curves and predictions of how variable rates are going to change. What's the index behind whichever lender is using. We went super detailed in this model, and we put this calculator on our website, so anyone could come and put their best fixed rate, the best comparable variable rate, and it would just tell you which one's better academically, right? No one cared. No one cared. People do not make this decision based on math, right? They make this decision based on more emotional decision, right? And so because of that, we've taken down that calculator. It no longer exists on our website. Instead, what we generally encourage students to think about is, okay, this is the best fixed rate you're offered. What's the best variable rate that you're seeing, right? And is the difference large enough, where fixed rate higher, variable rate lower, that you're willing to take the risk of this fluctuation? And that's the mental model that we found people are using to make that decision. Is it academically correct or not? I think it's not academically correct, but it is the model that we find resonates with people in terms of how they make that decision between fixed and variable. We've also heard sometimes students come in and ask for variable rates, saying, hey, I want variable rate because I think rates are going to come down over time. What we find in the numbers is, even if they're asking the question, they're not selecting the variable loan when it comes down to clicking the button on the website. So it's very, very interesting, this question of fixed versus variable rates. But yeah, I would say for 2025, we saw a dominant, fixed rate selection in the population we know best. Yeah.
So aside from the interest rates, what are some of the other factors that can really have a massive impact on the total amount of fees that someone will pay? Like, are there upfront fees? If someone's got a bad FICO score, do they tend to get, I'm assuming they would get a higher interest rate. Can people extend their payment terms? This is sort of a more taking a step back and a more basic question about, like, okay, I've got the loan, I'm about to graduate. What are some of the different things that might impact the amount I pay total over the next 20 or 30 years?
Absolutely. Generally, what we find is the slower that you pay back a loan, you have two sort of compounding effects that make it more expensive. The first effect is just that you have more principal due for a longer amount of time, right? You're paying it back slower. The second effect is the lender is often charging you a higher interest rate when you're choosing to pay it back more slowly. So then you might ask, well, why would anyone pick these repayment plans that are a slower timeline? Well, it's because you've got to manage your monthly cash flow, right? And you don't want to sign up for too aggressive of a repayment plan, because then, well, you might not be able to make the payments. Or sometimes you can make the payments, but it comes at the cost of other life goals that you have. I was speaking to a MBA grad And we do a lot of webinars. We added this deck into the webinar because of some conversations like this. They really wanted to buy a house, and they realized they've put every dollar that they make into aggressively paying down their student loans. This was someone who graduated with like 200K plus of student loans, good job, six-figure salary, all that good stuff, right? But every dollar they make, just plow it into the student loan. They don't have enough for a down payment on a house, right? And they live on the coast. Every year that they wait, they want to buy like $1 million house. So every year that they wait, 4% annual average appreciation, that's $40,000 on the price of the house that's going up. And then if you think about the mortgage on, it just compounds. So you want to balance life goals, right? If you want to buy a house, buying the house is one of the biggest things that come up. And unfortunately, no one thinks about it while they're in school. No one thinks about it when they're selecting the loan term, right? This is something you think about 2 years after you've already been making payments on your loan. I think it's short-sighted to try to just like minimize the interest on this one loan. You want to think a little bit more holistically about your life goals, and how your personal finances play into that. And maybe, you pay extra, 5-7 grand on your student loans, but you bought a house 1 year sooner, and that more than offsets the delta.
I'm surprised that an MBA graduate wouldn't have put a little spreadsheet together, like looking at the opportunity costs and the interest rates, but that's neither here nor there.
I mean, I had the same thought when he was talking about the tool that they removed because nobody was using it. It was like, you would think if there was a population of people that would have absolutely loved that kind of data. But yeah.
We need a behavioral economist amongst us to help us understand why these things happen.
So connected to the lifestyle question, but in a different way, is that while you were in school, different loans offer different options for whether or not you can just like pay down the interest. Some require full deferment. What advice would you give to people for managing their loan while they're in school?
I would say, I've seen some people take these strategies where they want to sign up for the more aggressive repayment plan, because they see the lower interest rate, right? And that's what attracts them to these more aggressive repayment plans. If they have an income to support that repayment plan, right? Like maybe they have a side hustle, maybe they're not doing this full time, maybe they have a spouse, right? Or maybe they're getting support from family. If they have some sort of income that can drive making those payments, absolutely, it can make a ton of sense to sign up for those more aggressive repayment plans. Sometimes we see like a difference of like 7.5% to like 5%, right? Like that is a meaningful difference, and you should be willing to make some adjustments to your lifestyle to get that much of a delta, especially if you're borrowing a large amount, right? Like if you're borrowing $100,000, $200,000, like that makes a difference. But what we find for the vast majority of students, it's very hard to actually make those payments other than borrowing more to make those payments, right? And that defeats the purpose of anything. So what we find is a vast majority are opting for a deferred repayment plan or a min pay, which is like $25 per month while you're in school. Those are the repayment plans that are more popular, and the ones that are more aggressive than that, interest only or even immediate, where there's really no you start making, call it the full payments, a little bit of principal and interest each month. Those tend to have lower adoption because it's just so much harder to make those payments. Now, I recognize for international students, sometimes the choices are even thinner, right? Where there may not be a real choice to not sign up for one of those more aggressive repayment plans. And in those situations, they often have to lean on family support or some other means to make sure that they can make those payments. That's a situation where lack of choices is just going to drive what you do. But when there is choice, the other thing I like is like MBA school, there's sort of the sticker price of MBA school, right? Like you go to the cost of attendance on the financial aid website and there's a price. But at many programs, there's this tendency for a strong social life, a strong travel culture that can drive expenses beyond what's on that, estimate from the school. Um, and that's the other reason you want to be conservative in your budgeting, right? Loans will not cover funds needed for that stuff, right? The maximum you can borrow through loans is the cost of attendance published by the school. So if you need money more than that, that's where your savings or dissolving your stock portfolio or taking help from family that's what it's going to fund ultimately. So you want to be careful that you don't earmark that for paying down your student loans while you're in school. And now you and to be frank, I found people have um, a very good experience in business school, regardless of their budget, right? Obviously, yes, there is some activities you have to stop yourself from participating in if you don't have that budget. But oftentimes there are alternative things to do on campus that are just as fun. You form equally strong networks. You've just not spent $5,000 making a trip around the world, in the process.
I ask you one question that's a bit of an audible that occurred to me when you were talking earlier about the big beautiful bill, and this is a bit of a bee that's in my bonnet because I've been talking to so many immigration people, and I don't know if this is something you have an answer to, so it can be cleanly cut, perhaps. But one of the challenges with immigration is the worry that after business school you might not be able to stay in the United States, and so that might change the risk profile for lenders. Have you heard anything about how changing immigration rules might alter people's risk calculation, which in theory could ultimately have some impact on everything from interest rate to whether or not loans are given, or is there just not data on that yet?
I mean, certainly there's no data, but there is, I would say the bigger problem is the lack of discussion, right? But in a hypothetical world, if that discussion was going on 100%, it would be a concern that's brought up, right? I do think there is, this call it understanding, right? That, hey, I don't think that's going to happen. As in, we think that there is still going to be a strong job market for immigrants who come and pursue good degrees in the United States, right? I think the challenge is, do you believe it enough that you're willing to put $100 million to work, right? And ultimately, what we find is, it depends on the exact lender we're talking about, but many lenders are bound not just by gut feeling or their trust or levels. They are bound to either a LP, right, of some sort, someone behind them that truly holds the money, right? And there's going to be rules as in like underwriting criteria that those people want to see, right? So it's almost a two-step discussion in creating a strong product for international students. Is the lending process and the exact underwriting, etc. But do you have buy-in from the capital sources to actually hold those loans on the books for a long amount of time? And I think that's really the more challenging piece. If that is solved somehow, I don't know how, somehow, that's when the rest of the process gets easier, right? But that's the $1 million question.
So if we were to sort of wrap up, what's like the main sort of takeaway that you would want our listeners to know about student loans in general, or about working with your firm specifically? What's like the key takeaway?
I'd say the first thing is be thoughtful, right? Be very thoughtful about your student loans. This is not one of those decisions where it has no impact. Just take a student loan, the first one that comes by. That's not the approach you should have towards your student loans. Be very thoughtful about it. Take advantage of Juno. Juno is a free service. Folks like myself, including myself, are very easy to book one-on-one time with. You can just go to join Juno, hit the contact session. You can get on a Zoom call with me or like 4 other MBA students or MBA alumni, right? And a few other folks, all of whom have a lot of in-depth knowledge and have guided thousands of students, right? So utilize that resource. Juno is a free option. We have, ask your classmates in the classes above you. They have very likely heard about Juno and or utilize Juno themselves, so you can get a reference check. Yeah, but ultimately, just be thoughtful about it, right? Don't make these decisions casually. You are probably very smart if you're coming to one of these business schools. So spend the attention, spend the 30 minutes diligencing it and figuring out what's the best decision for you, and I think that'll serve you well.
Nikhil, thank you very much. Nikhil Agarwal, make sure I get that right. You're not Nikhil Juno. Thank you for joining us here today on GMAT Club. And as always, my co-host, Maria from ApplicantLab.com. And I'm Brian Phoebe with GuruFi.com. I almost messed up my own name. I am Brian Phoebe with GuruFi.com. It's been a long week. Thank you for joining
Guru.
us at GMAT Club. What's that?
You're Brian Guru. I'm Maria Lab. It's Nikhil Juno.
It's like old-timey England. Your last name is your job.
Yeah, exactly.